Okay, I'm going to go ahead and get started. It's 2 o'clock. Thank you, everybody, for joining me. My name is Kelly Ann Worthington. I'm a senior loan officer with Cross Country Mortgage. And every week, starting moving forward on Wednesdays at 2 p.m., I'm going to be doing different mortgage topics that you are welcome to watch as a realtor or as a potential buyer looking to buy. My goal is to have information that is helpful to anybody, no matter what side of the fence you're on in regards to that. So, my name, again, is Kelly Ann Worthington. I am a senior loan officer with Cross Country Mortgage. I've been in the mortgage industry for a little over 6 years now and absolutely love what I do. It's a passion of mine to not only help clients get homes, but make the process as smooth as possible. And I think if you look me up under Google or Zillow, you'll find that that is the experience that my clients have working with me. And it's just a big goal of mine to make this process that can be sometimes daunting and scary, the best, process that it can be for you. Okay. So, why this matters, right? So, we're going to talk about Mortgage Basics 101. So, buying a home is likely the biggest financial decision you are ever going to make. It's the largest purchase almost anybody will ever purchase in their lifetime. But most people don't fully understand the mortgage basics behind it or why choosing the right lender to hold your hand through the process can matter. So, what we're going to cover today, we're going to talk a little bit on each topic. On other Wednesdays, I'll dive into more information, but we're going to talk about how mortgages work, what type of home loans are out there, what affects you getting pre approved, as well as what affects the costs and your interest rate when you get pre approved, what the home buying process is like, as well as mistakes to avoid. So, what is a mortgage? So, by simple definition, a mortgage is just a loan used to purchase real estate, right? Just like you would go to a car dealership and get a car loan, or go to a credit card company to get a credit card, or go to a bank to get a personal loan. A mortgage loan is to purchase real estate property. So a property that is deeded and titled as residential real estate, or on the commercial side, commercial, but we don't do that here. So we're going to talk just about residential purchasing. The key components of a mortgage are your principal, your interest, and the term of the loan. So principal is the total amount of loan that you actually borrowed. The interest is the amount of interest you are going to accrue and pay over the life of the loan. And then the term is the number of years that your loan is going to take to get paid back. Now, your monthly payment breakdown is comprised of what I call PITI, PITI, principal, interest, tax, and insurances. Insurances, there sometimes are two different types of insurance on a loan. So regular insurance means homeowners insurance, and then PMI is your private mortgage insurance. That is basically the insurance to cover the lender in case you default on a loan. So your principal is the amount that you borrowed. The interest is the cost of you borrowing. Your term is your loan length. And then PITI is your total monthly payment, all combined into one. So your monthly payment breakdown consists of multiple different things. So like we talked about, principal and interest is your loan amount and the interest that you're going to pay monthly on your mortgage. Your property taxes are determined by your county. So your lender actually has nothing to do with what your property taxes are. Where your principal and interest typically on almost all loans other than a ARM are going to be a fixed set mortgage rate, right? So your principal and interest will never change for the life of the loan. Your property taxes can. If the county increases or decreases property taxes, that will affect your mortgage payment. Same with homeowners insurance. Every year, your insurance pays an annual premium out of your mortgage payment, right? And your escrow account. So the homeowners insurance can also change if your homeowners insurance premium changes. PMI, if applicable, and we'll get into which ones have it and which ones don't. And then HOA fees. Now, it's important to understand an HOA fee stands for Homeowners Association fee. Sometimes you have it if you live in a condo. Other times you have it if you live in a PUD, which is a planned unit development. So let's say you live in a planned community and they maybe have a $50 a month maintenance fee and it takes care of your landscaping. That's considered an HOA fee. Now, the HOA fees will never be part of your mortgage payment, but they do factor in when you're looking to purchase a home. So let's talk about different loan types. So the first type we're going to talk about is what is known as a fixed rate conventional mortgage. So it has the same rate for the entire life of the loan. It's never going to change. And then you also benefit of this are predictable payments. It's good for long-term stability. The other benefit to conventional loans is you can get rid of your PMI insurance once you either do a 20% down payment or you pay off 20% of the loan. So at that point, the PMI comes off and then you no longer have that on the loan. The next type of loan are known as government-backed loans. So these are things like FHA loans, VA loans, and USDA loans. So FHA loans don't mean that a buyer has to be less qualified than conventional, but what it does as a benefit is it allows lower credit scores than conventional typically does. Now, there are nuances to all of these, and we'll get into those on different Wednesdays. But typically, FHA will allow you to go as low as 500 on your credit score. You want to try to always have a credit score above 600 if possible, though, because it makes it much harder to get pre-approved, and you will definitely pay for it in the costs and your rate. But it also allows, as a benefit, low down payment. So the minimum down payment required for an FHA loan is 3.5%. Now, on a conventional loan, if you're a first-time home buyer, you can go as low as 3% down. Everybody else, whether they own one home or more, can go as low as 5% down. Then on VA loans, if you are a qualified veteran, meaning that the VA has approved you eligible to get a VA loan, which you can check with the VA on that if you are currently an active service member or retired and separated from service member. But VA loans are allowed for veterans, veterans and their spouses, or widows of veterans, again, as long as they're qualified. Benefit to VA loans is there's no down payment. Now, they do have a funding fee, so they don't have mortgage insurance, but VA loans come with the standard funding fee unless they are exempt as a veteran, and that gets added into the loan as part of your loan amount. So if you are getting a loan for $200,000, your standard loan amount is $200,000, but then that funding fee gets added into there to get paid back in the mortgage. And then USDA is the other government-backed loan. Now, VA, again, typically will allow as low as 500. You always want to try to keep it above 6 if possible. USDA typically wants you above 640. They can go below it, I believe as low as 580. It kind of changes sometimes, but typically, again, on USDA, to get the least amount of cost incurrence, you want to try to keep that score up above 640 or higher. Now, the benefit to USDA is it is a 0% down payment loan as well. It does not have PMI, but it does have a fee that goes into your mortgage payment. So that's something to be aware of, because sometimes people think because it's USDA and it doesn't have PMI, there's just nothing additional. But they do have a USDA fee that is part of your mortgage with that. Now, the benefit to USDA, again, is that 0% down payment. But the USDA loan type compared to the other loan types is address specific. And what do I mean by that? I mean that in USDA loans, you have to make sure that the property is located in a USDA area. And that is, the properties are address specific. So you might, if you're on a border of those areas, have one house that is USDA eligible, and then on the other side, it is not USDA eligible. So there's a website that you can go to, and if you ever want that, you can reach out to me and I can give you the website, but there's a website to go to put addresses in, and it'll let you know if that property is USDA eligible or not. Now, another type of loan is called an ARM, or an adjustable rate mortgage. Typically, they will have lower interest rates. However, those rates are not fixed. They adjust throughout the life of the loan. Your payments can increase. There typically is a balloon payment at the end of it where it's due in full all at once at the end. And the benefit is it's a shorter term loan for, let's say you are a doctor and you're moving into a city for 4 years, and you know what your income's going to be, you know you can make the payments, and then you know you're going to sell the house. You know, that might be something you want to look at. Now, typically people think ARMs are always going to be a lower interest rate, and that's just not true. It depends on what the market's looking for. So sometimes they can be higher, and they are also higher risk loans, because if you can't sell the house or you don't have the money to pay off that final payment, that can get you into a lot of trouble. So they are definitely a higher risk loan than the other standard loan types that we've discussed. And then the final type of loan, which are not, there's so many hundreds of nuances, but they're called non-conforming loans or non-qualified mortgages. They're essentially loans that are not following the standard government regulations. They're more in the private sector. Examples of these could be bank statement loans for self-employed borrowers who maybe write off all their income, but they show a ton of money coming into the business, and we can use a 2-year average of the income coming in through the bank statements. There's also DSCR loans, which stands for debt service coverage ratio loans. Those are an investment loan where it doesn't care about income. It just cares about the money you have, the reserves you have, your credit score, and that it's an investment property. So these, along with many others, can definitely be ones we can look at for random weird situations that maybe don't follow the standard government rules. It's important to know with non-conforming loans, however, you are definitely going to be facing higher interest rates as well as higher costs or points on the rate as well. Now, what affects your rate? So this is one of the common questions. I always have clients call and they'll say, well, what's the rate that you guys have right now? Lenders don't have rates. Lenders are the lender giving you the loan. You, as the buyer, are the one that has the rate, meaning you are the one that determines what your rate is based on your file. So things like your credit score, your down payment percentage, your loan type, the loan term, your debt to income ratio, meaning what your total monthly debts are on credit plus the mortgage payment versus what your income is, as well as market conditions, right? If something's going on in Europe that's affecting the world, or here that's affecting the world, that can have a negative or positive impact on the secondary mortgage market because it's affected by the stock market, the federal government, et cetera. So the market itself can change what the rates are on a daily basis. So those are things to just understand, is that you, as the borrower, are the one that has the rate. The lender doesn't have the rate. Now, the mortgage process, this is the very simplified, watered down version of it, but essentially step one, you want to decide you want to buy a home, right? You want to find a realtor that you trust, that you believe can be the right fit for you. Your realtor is kind of like a home shopping therapist. So you really want to make sure you choose somebody that you feel comfortable with, that you vibe with, that you feel comfortable being around, because you're going to be around them a lot in that process. You then want to get pre-approved with lender. Obviously, I would love if every single person in the universe chose me, but you can also ask your realtor for who they trust, that they recommend, that they've worked with, etc. No matter who they recommend, no matter who you're thinking of going with, you always want to look that lender up and find reviews. You want to interview lenders not based on asking them about a rate, because if you are doing that, they're all just going to tell you a low number, and it's not going to be your rate once you get an accepted offer anyway. So instead, find out what is their availability. How quickly do they respond to phone calls, text messages, and emails? What do their reviews say about them? What do realtors say about them? Can you find their office location so that they're not some random person behind a computer that you can never get a hold of during the most important purchase of your life? So getting pre-approved is the next step. That's where you're going to fill out the application to put in your basic 2-year work history, 2-year living history, your basic information like date of birth, social security number, phone number, email, etc. The lender then reviews the application, verifies the income and assets, issues you a letter, lets you know what you can afford, what those payments look like, and then you go from there. So then you go out to find a home, right? You're going to go tell your realtor what you're looking for. They're going to start to show you properties that are on the market. You make an offer. Once you get your offer accepted, then the loan process starts. The loan process typically takes a maximum of 30 days. Sometimes it can take less, sometimes it can take more, depending on extenuating circumstances. Maybe a seller didn't have something ready that they needed, or an appraisal comes in and has an issue that takes a little bit of time to resolve, things like that. So then you're going to have your appraisal. The appraisal is where a third party called an AMC, an appraisal management company, is hired to go out and send an appraiser out to appraise the home. And they are doing a few different things with that. One, they're comparing comparables that have sold recently that are similar to that property, so that they can determine what the value of the property is. Two, they're also determining the safety and soundness of the home. So each loan type has specifics of what they are looking for to make sure that the home is safe and sound for you to move into without danger. So that is the appraisal. And then the underwriting process. So where the appraisal is kind of the review of the home, the underwriting process is the review of you. I apologize. So where the underwriting process happens is that is the, kind of heavenly God of the loan world is the underwriter, and they are going to go in and review your file, ask for, sometimes additional documentation or questions that they need answered, etc. So after that, then the closing happens. And the closing is once you get a clear to close with the lender, then the title company works with you to get the deed transferred over into your name. You sign a bunch of documents, and then you get the keys to the home. So that's the basics of the home buying process. Now, let's talk about upfront costs. So most people know about down payment. It's a very common word that, few words that are talked about, but they don't realize that there are other costs when buying a home. So let's talk about those. So your down payment is the percentage of the purchase price that you plan to use to put down as the down payment on the home. So for example, we'll keep the math simple. Let's say you're buying a $100,000 home and you are going with an FHA loan, which requires a minimum of 3.5% down. That means your down payment would be $3,500. Okay. So the next cost are closing costs. And some people have heard of these occasionally. Closing costs are combined of all of basically the third-party things that happen and third-party companies that are working together to help you get your home. And those are the costs that they get paid to do their job. So the lender gets paid, that's one cost. Your title company is going to be your biggest chunk of change out of that, right? The title company is, again, the company that helps transfer your deed over, make sure there's no hidden liens with the seller, that the taxes are paid and up to date, etc. Then you have things like your appraisal fee, your recording fees and transfer taxes with the county, your property survey, your flood cert, your credit report. So all of those costs combined are what are known as your closing costs. Now, closing costs are typically going to range, but all dependent upon purchase price, somewhere between $5,500 to $7,500, give or take, depending on the property, purchase price, etc. Now, the third cost is what a lot of people don't think about or aren't aware of or aren't told about, and those are prepaid expenses. So what are prepaid expenses? They are combined of four different things. So the first part is mortgage insurance. So your prepaid mortgage insurance, prepaid mortgage interest, and that is determined by you by the day you choose to close in a month. So if you closed on the 28th and there are 2 days left in the month, you are going to pay 2 days worth of prepaid interest for those remaining days. The other thing to be aware of in prepaid expenses is it pays for your first year of homeowners insurance. So homeowners insurance is paid in arrears. So it is paid ahead of time for the entire first year. And each year it's an annual premium that covers the next full year. So what the insurance cost is determined by the insurance company you go with and the coverage you choose. But that first year of your premium is going to be part of those prepaid expenses. The two other costs that go into that are things known as escrow accounts for taxes and insurance. So a lot of people think, and I know I did when I bought my first home, that when you make your mortgage payment, and like we discussed, it's comprised of your principal, your interest, your property taxes, and your insurance, that each month when you make that payment, that money for insurance and taxes gets sent off to the county and to the insurance company. But it doesn't. What happens is that money goes into what's known as an escrow account where it sits, and then depending on your state, it's different. In Ohio, for example, taxes are paid twice a year. So every 6 months when taxes are due, the mortgage company pays your taxes to the county for those 6 months out of your escrow account. Same for the insurance. It's paid once a year. So every year when the bill comes due, they take that money out of the escrow account and they pay that bill. So those four things, prepaid interest, your homeowner's insurance annual premium, and then your escrow accounts, which are determined how much you are collecting for that as a lender is determined on the county, how often the things are paid, when they're paid, and how much, right? And when you're closing in a year. But so prepaid expenses typically for standard purchase prices are going to be somewhere between $2,500 to $4,500 on average, depending on your price point. So those are prepaid expenses. There are two other costs that come when you get a mortgage. They are the home inspection and the appraisal. So your home inspection is not required by a lender. Lenders do not require home inspections, but everybody typically recommend you do one. A home inspection is basically an inspector that goes in, typically within the first 7 days after you get an accepted offer, with you into the property. And their job is to kind of look and nitpick every single thing that could potentially ever be an issue in the property. Don't be afraid of home inspections. They're going to come back with a lot of stuff. Your realtor can help guide you through, are any of these things major issues or not? But that's a home inspection. Home inspections are typically charged by square footage of the house, and you are allowed to choose whatever home inspector that you want should you choose to have a home inspection. And you always want to refer to your realtor to ask those questions, not your lender, because that's part of their lane of what they are trained on. Now, the home appraisal is not optional. It is part of the loan process and it's required. The lenders are not the hirers of the appraisers. The appraisers do not work for the lending companies. We're not even allowed to talk to them. So they are actually hired by the AMC, the appraisal management company, and they go out to do the job of determining the value of the property. The cost of the appraisal is based on two factors. One, the loan type. So the government sets a standard loan fee, appraisal fee based on loan type, but also your location. If you're in an area that is a high populated area, appraisal costs will probably be a little bit less and they'll get out very quickly. If you are in an area that's more rural and there's maybe only a few appraisers, the cost might be higher. That might take a little bit longer to get the appraisals back. Also, your property type will determine your costs. A single family home is going to have a lower appraisal than a multifamily home. So those things are what determine the cost of the appraisal. Ongoing costs of getting a home. So you have your monthly payment. You have maintenance and repairs that come up with the property, and then you have HOA fees. So one thing to be aware of and be mindful of, especially if you're looking into condos, is that the HOA fees can change. So HOA fees essentially are the costs of the condo being maintained, inspections, repairs, the insurance costs, things like that, all divided amongst all of the people in the HOA association. So just know that those can change, and you want to be mindful of that with what your costs are and what you're comfortable with payment wise, to be like, okay, if this goes up, am I going to be comfortable with that, or would that put me into a difficult situation? Common mistakes when going to buy a home. Number one, buying too much house. So there are plenty of lenders out there that'll just be like, congratulations, you're pre-approved. Here's the maximum amount you can purchase. And you're like, great. But what happens if you don't discuss what that payment is, and you fall in love with $300,000 house, but then you find out after getting an accepted offer what that payment's going to look like, and you really wanted the payment of a $200,000 house. So one of the things I always work with my clients on is, once we know what they can buy, I always ask them, what is the maximum mortgage payment you feel comfortable making, right? Including your taxes and insurance, because that might lower where you want to look, and you want to make sure you're falling in love with the house that you can afford and you feel comfortable making that payment on. So don't buy too much house if that's not the payment that you're wanting. Next, don't only focus on monthly payment. So sometimes people will be like, well, that payment's $20 more than what I planned. If it's within your comfortability range to be able to get a little bit more house, to be in a different scenario for yourself, also keep that in mind. Remember, it's different than renting when you're buying, because when you're buying, as you make those payments are building equity in your property. And what is equity? Equity means every single month when you make a payment, a percentage of that payment is paying down the principal, so that when you choose to buy and sell down the road, that equity is there in the home, and you can use that equity to purchase your new home, have money left over if you are able to, etc., to put in the bank. So remember, when you rent, you're just giving somebody else money to pay on their mortgage, but when you buy, you're actually making payments to build your future equity for yourself and your family. Another common mistake, going with any random lender that you find online. So many people will just go to a random mortgage company's website and just be like, I'll apply, send me somebody random. I don't ever recommend doing that. You want to know your lender. You want to know their reviews. You want to know who they are. You want to talk to them, make sure their style, their flow is comfortable for you, because that if and when there is anything that hits the fan in a buying purchase, you want to make sure that you have a realtor you can rely on and trust, and that you have a lender that you can rely on, you can trust, and you know they're going to get the job done for you. Because if you pick a random lender who doesn't do their job, and there are plenty out there, what can happen is they could give you a pre-approval and not do their job of verifying information. And then you go and you get an accepted offer. You pay, say, $500 for a home inspection, $500 for an appraisal, and then the loan gets denied afterwards. You can't get that $1,000 back. So finding and choosing the right lender for you that is reputable, that is available, that is trusted, that is the lender that you definitely want to choose. And then the other thing that you want to never do is don't make big financial changes before closing on a home. So during the loan process, you do not want to change jobs. You do not want to go out and buy furniture preparing to buy. You don't want to open up new credit cards. You don't want to spend money on your current credit cards, building up the balances, etc. Prior to buying a home, please, if you do not have to, do not buy a new car right before buying a home. The reason why is car payments, especially as we continue forward, are increasing and increasing, and they eat up a ton of what's called your DTI, your debt to income ratio, because the payments are so high. So if you currently have a car and you're thinking about buying a home, don't buy a new car until after you buy the home, because the qualifications for both are very different, and it can very much affect your purchase price capability for buying if you buy a car prior to buying a house. So that's just something to be mindful and aware of. So a few smart tips that I think are super helpful for home buying. Number one, check your credit early. So often people are afraid to get their credit checked, and it's not the same as when you go to buy a car. I know when you buy a car, they check like 80 different companies, bam, 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 your credit gets annihilated. It's not the same for buying a home. You are allowed one credit check every 90 days without penalty. I believe the score goes down 5 points, and 30 days later, it goes right back up. So check your credit. So many people wait until they have to buy to go to a lender to find out what their situation is. Right. Rather than doing that, go to a lender that you know you can trust, get a name from somebody, come to me, etc., and say, hey, I'm not ready to buy yet, but I would like to find out where I'm at. Most lenders are able to do what's called a soft credit check, where we know you're not looking to purchase right now, but you want to see kind of where you're at with your debt, your income, your money. We can use that soft check, which does not show up as an inquiry on your credit. And then it allows us to see where's your income at, where's your debts at, where's your money at. I call them the 3 puzzle pieces to getting pre-approved, right? And we can help you build a map of what you need to do to get ready within the time frame that you want. So definitely work with a trusted lender to review your current situation to prepare to buy. Save beyond your down payment. Again, we talked about those costs, 3 costs to a mortgage, your down payment, your closing costs, your prepaid expenses. So save up more than just the down payment. The more money you have saved up, the less you have to ask for money from a seller or go with a down payment assistance program, because nobody gives money for free. So they always come with either higher rates, restrictions, costs, etc. You want to try to save up as much as you can, but remember, you don't have to put 20% down. You can purchase a home with less money than what you think, which is why going and talking to a lender about your situation will help you. Always get pre-approved first. Do not go shopping for homes before you've been pre-approved. You do not want to fall in love with a home. And you also, to be honest, if I'm being frank, don't want to waste your realtor's time. Realtors do not get paid by the hour. They are spending money on gas. They are spending money on researching for you on properties to buy. They're taking the time away from their families to go show you houses. You want to make sure that you know you can afford the house and are able to get pre-approved to buy the said house before you go look at it. I promise you. Too many times I've seen clients who fall in love with the house, then they go get pre-approved and find out they can't buy it. Don't do that to yourself. And then finally, just ask questions, right? If you have a lender who does not want to answer financial questions, number questions, be there to help hold your hand through the process, it's not the right lender, right? Big red flag. So ask questions. There are no stupid questions. This is the biggest purchase you're ever going to make in your life, and you want to make sure you're working with somebody who is happy to answer those questions anytime you need it. So key takeaways: understand your total costs, understand your situation. Don't just focus on payment. Know that there are different options out there available to help with things. But again, prepare ahead of time so that you know you're going to be able to buy when you're ready. Your rate depends on you, not on the lender. And preparation saves money. So it will save you time. It will save you stress. It will save you costs if you prepare ahead of time. So I just want to thank everybody for joining me today. I hope you had some good takeaways from this. You are always welcome to call, text, email me, reach out to me on Facebook. The QR code there, if you want to scan it with your phone, is to my virtual business card. I am available 7 days a week, 8 a.m. to 10 p.m. on nights and weekends, etc. And my website is applywithkellyann.com. So thank you so much. I hope you guys have a great rest of your day. Bye.